Wealthy individuals often employ a variety of sophisticated investment strategies to grow and protect their wealth. These strategies are designed not only to generate returns, but also to mitigate risk and optimize tax efficiency. Here are 15 investment strategies commonly used by the rich. 1. Diversification. Diversification involves spreading investments across various asset classes, such as stocks, bonds, real estate, and alternative investments, to reduce risk. This strategy is akin to the adage, "Don't put all your eggs in one basket." By investing in a variety of assets, investors can protect themselves from significant losses if one particular investment performs poorly. For instance, if the stock market experiences a downturn, bonds or real estate investments might remain stable or even appreciate, thereby cushioning the blow and balancing potential losses. The rich diversify their portfolios to ensure that poor performance in one area does not significantly impact their overall wealth. This approach is crucial for preserving capital and achieving steady growth over the long term. Diversification can take several forms. First, there is geographic diversification, which involves investing in different regions or countries. This strategy allows investors to capitalize on growth opportunities in various markets and to protect against region-specific risks. For example, political instability or economic downturns in one country might not affect investments in another. Second, sector diversification spreads investments across different industries, such as technology, healthcare, finance, and consumer goods. Each sector has its own set of risks and growth potentials. By investing in multiple sectors, wealthy investors reduce the impact of sector-specific downturns on their portfolios. Third, asset class diversification balances investments among stocks, bonds, real estate, commodities, and cash equivalents. Each asset class reacts differently to economic conditions, so this type of diversification helps manage risk and optimize returns. For instance, while stocks may offer high returns, they also come with higher volatility. Bonds, on the other hand, typically provide lower returns but offer more stability. Finally, investment style diversification includes a mix of investment approaches such as growth investing and value investing. Growth investing focuses on companies expected to grow at an above-average rate compared to others, while value investing targets undervalued companies with strong fundamentals. Combining different styles can enhance portfolio performance across various market conditions. By implementing these diversification strategies, wealthy individuals not only protect their wealth, but also position themselves to take advantage of a wide range of investment opportunities. This comprehensive approach to diversification is a key factor in their sustained financial success. 2. Real estate investments. Real estate is a favorite among the wealthy due to its potential for appreciation, income generation through rentals, and tax advantages. This asset class is often seen as a tangible and relatively stable investment, providing both capital appreciation and regular income. Wealthy individuals invest in various types of real estate to diversify their portfolios and capitalize on different market dynamics. One primary avenue for real estate investment is residential properties. These include single-family homes, condominiums, and multifamily apartment buildings. Residential real estate can generate income through rent and appreciates over time, offering a dual benefit. Additionally, owning multiple residential properties can provide a steady and reliable income stream, as people always need places to live. Another significant segment is commercial real estate, which includes office buildings, retail spaces, and hotels. Commercial properties often have longer lease agreements compared to residential properties, ensuring a more stable and predictable income flow. Wealthy investors favor commercial real estate for its potential higher returns and the opportunity to benefit from the success of businesses occupying these spaces. Industrial properties are another crucial part of a diversified real estate portfolio. These include warehouses, manufacturing facilities, and distribution centers. The rise of e-commerce has significantly increased the demand for industrial properties, making them a lucrative investment. These properties often have long-term leases with corporate tenants, providing steady cash flow and lower vacancy risks. In addition to direct property investments, Wealthy individuals often invest in real estate investment trusts, or REITs. REITs are companies that own, operate, or finance income-producing real estate across various sectors. They offer a way to invest in real estate without the need to manage properties directly. REITs are traded on major stock exchanges, providing liquidity and the ability to easily buy and sell shares. They also offer dividends, which can be an attractive income source. Real estate investments come with significant tax advantages. Investors can benefit from deductions related to mortgage interest, property taxes, operating expenses, depreciation, and repairs. Additionally, strategies like 1031 exchanges allow investors to defer capital gains taxes when they sell a property and reinvest the proceeds into another qualifying property. This deferral can lead to substantial tax savings and enhance the overall return on investment. Moreover, leverage plays a critical role in real estate investment. Wealthy individuals often use borrowed capital to purchase properties, amplifying their investment potential. By putting down a relatively small amount of their own money and financing the rest through a mortgage, they can control a more substantial asset and increase their potential return on equity. Real estate's inflation hedging properties are another reason for its popularity among the wealthy. As inflation rises, so do property values and rental incomes, providing a natural hedge against the eroding purchasing power of money. This characteristic makes real estate a valuable component of a diversified investment portfolio, particularly in inflationary environments. In conclusion, real estate offers a combination of income, appreciation, tax advantages, and diversification benefits that make it an essential part of wealth-building strategies for the rich. By investing in various types of properties and leveraging the advantages of REITs and tax laws, wealthy individuals can achieve robust and stable returns over the long term. 3. Private equity and venture capital. Investing in private equity and venture capital allows the rich to support startups and private companies with high growth potential. These investments can yield substantial returns, although they also come with higher risk. By investing in private companies, wealthy individuals can access opportunities that are not available in the public markets, often before these companies become widely known or go public. Private equity involves investing in established private companies that may be looking to expand, restructure, or even go public. Private equity investors typically take a significant stake in the company, providing not only capital but also strategic guidance to help the company grow and improve its operations. This hands-on approach can lead to substantial value creation and, consequently, high returns when the company is eventually sold or taken public through an initial public offering. IPO. Venture capital focuses on early-stage startups with innovative ideas and high growth potential. Venture capitalists invest in these young companies, often in exchange for equity stakes. While the failure rate for startups is relatively high, the potential rewards from a successful venture can be enormous. High-profile success stories like Facebook, Google, and Uber have highlighted the transformative potential of venture capital investments, making them an attractive option for wealthy investors willing to take on higher risk. One of the key advantages of private equity and venture capital is the active involvement investors can have in the companies they back. Unlike public market investments where shareholders have limited influence, private equity and venture capital investors often take board seats and work closely with management teams. This active involvement allows investors to help steer the company towards growth and profitability, increasing the likelihood of a successful exit. These investments also offer portfolio diversification. Private equity and venture capital are less correlated with public markets, meaning they can perform well even when stocks and bonds are underperforming. This characteristic makes them valuable additions to a diversified investment portfolio, providing an extra layer of protection against market volatility. The long-term horizon of private equity and venture capital investments can also be beneficial. These investments typically have a longer holding period, often ranging from 5 to 10 years. This long-term perspective aligns with the goals of wealthy individuals who can afford to lock up their capital for extended periods in pursuit of higher returns. Access to exclusive deals is another reason the wealthy favor private equity and venture capital. These investors often have connections and networks that provide them with opportunities to invest in high-potential companies before they become accessible to the broader market. This early access can lead to significant returns, particularly when the companies achieve substantial growth or successful exits. However, these investments are not without risks. The illiquid nature of private equity and venture capital means that investors cannot easily sell their stakes before the investment reaches maturity. Additionally, the high failure rate of startups and the potential for significant losses in private companies require investors to have a high tolerance for risk and a robust strategy for selecting investments. Wealthy individuals often mitigate these risks by investing through private equity and venture capital funds managed by experienced professionals. These funds pool capital from multiple investors and spread it across a portfolio of companies, reducing the impact of any single investment's failure. Fund managers bring expertise in identifying promising opportunities, conducting due diligence, and providing ongoing support to portfolio companies. In conclusion, private equity and venture capital offer wealthy investors the potential for substantial returns and the opportunity to play an active role in the growth of innovative companies. While these investments come with higher risks and longer time horizons, their ability to provide portfolio diversification, access to exclusive opportunities, and significant value creation makes them a critical component of sophisticated investment strategies used by the rich. 4. Hedge funds. Hedge funds use various strategies, such as long/short equity, market neutral, and global macro, to achieve high returns. These investment vehicles are designed to capitalize on market inefficiencies and protect against downside risks through sophisticated and often complex financial techniques. Wealthy individuals invest in hedge funds to access these advanced strategies and potentially reap outsized gains. One popular hedge fund strategy is long/short equity. This approach involves taking long positions in stocks expected to increase in value and short positions in stocks anticipated to decline. By balancing these positions, hedge funds aim to generate returns regardless of overall market conditions. For example, during a market downturn, gains from short positions can offset losses from long positions, providing a hedge against market volatility. Another common strategy is market-neutral investing. Market-neutral funds strive to avoid market risk by maintaining balanced long and short positions, effectively neutralizing exposure to overall market movements. This strategy focuses on stock selection and aims to profit from the relative performance of different securities. By hedging out market risk, market-neutral funds seek to deliver steady returns regardless of market direction. Global macro strategies involve making broad bets on macroeconomic trends across global markets. Hedge funds using this strategy might invest in currencies, commodities, interest rates, and equities based on their analysis of economic indicators, geopolitical events, and government policies. Global macro funds aim to exploit significant shifts in the economic landscape, such as changes in interest rates or currency fluctuations, to generate substantial returns. Wealthy individuals invest in hedge funds to access these sophisticated investment techniques and the potential for outsized gains. Hedge funds often have the flexibility to use leverage, derivatives, and other complex instruments to enhance returns. This flexibility allows them to implement strategies that are not typically available to traditional mutual funds or individual investors. Leverage is a key tool used by hedge funds to amplify their returns. By borrowing money to increase their investment exposure, hedge funds can generate higher returns on their equity. However, leverage also increases risk, as losses can be magnified in the same way as gains. Wealthy investors, therefore, need to carefully consider the risk-return profile of hedge funds that use high levels of leverage. Hedge funds also offer diversification benefits. Their strategies often have low correlation with traditional asset classes like stocks and bonds, meaning they can perform well even when other parts of the portfolio are struggling. This characteristic makes hedge funds an attractive option for wealthy investors looking to reduce overall portfolio risk and enhance returns through non-traditional investments. Additionally, hedge funds provide access to unique opportunities. Many hedge funds invest in niche markets, distressed assets, and special situations that are not typically accessible to individual investors. This ability to explore a broader investment universe allows hedge funds to find undervalued or mispriced assets that can offer significant upside potential. Active management is another reason wealthy individuals are drawn to hedge funds. Hedge fund managers are often highly skilled and experienced investors with deep market knowledge and specialized expertise. They actively manage their portfolios, making real-time adjustments based on market conditions and new information. This active approach contrasts with passive investment strategies and can lead to superior performance in volatile or uncertain markets. Despite their potential benefits, hedge funds come with risks and high fees. They typically charge a management fee and a performance fee, often referred to as the 2 and 20 model, 2% of assets under management and 20% of profits. These fees can significantly impact net returns, especially in years of modest performance. Moreover, hedge funds can be highly illiquid, with lockup periods preventing investors from withdrawing their capital for several years. In conclusion, hedge funds offer wealthy investors access to advanced investment strategies, the potential for high returns, diversification benefits, and unique market opportunities. However, they also come with increased risks, high fees, and liquidity constraints. For those who can navigate these challenges and afford the entry requirements, hedge funds can be a valuable addition to a diversified investment portfolio, providing the potential for significant wealth growth and risk management. 5. Tax-efficient investing. The rich employ strategies to minimize their tax liabilities, which allows them to retain more of their investment returns. Effective tax management is a cornerstone of wealth preservation and growth. This includes investing in tax-advantaged accounts like IRAs and 401(k), utilizing tax loss harvesting, and holding investments for the long term to benefit from lower capital gains tax rates. By strategically managing their tax burdens, wealthy individuals can enhance their overall financial performance. One key strategy is investing in tax-advantaged accounts such as individual retirement accounts, IRAs, and 401(k). These accounts offer significant tax benefits. Contributions to traditional IRAs and 401(k) are typically tax-deductible, which reduces taxable income in the year of the contribution. The investments within these accounts grow tax-deferred, meaning that no taxes are owed on the earnings until funds are withdrawn. This allows the investments to compound over time without the drag of annual taxes. Additionally, Roth IRAs offer tax-free withdrawals in retirement, provided certain conditions are met, making them an attractive option for long-term tax planning. Another important strategy is tax loss harvesting. This involves selling investments that have declined in value to offset capital gains from other investments. By realizing losses, investors can reduce their taxable income. The losses can offset gains dollar for dollar, and if the losses exceed the gains, up to $3,000 can be used to offset other income, with any remaining losses carried forward to future years. This strategy is particularly useful for wealthy individuals with large and diverse portfolios, as it allows them to manage their capital gains and potentially lower their overall tax liability each year. Holding investments for the long term is another tax-efficient strategy. Long-term capital gains, which apply to investments held for more than a year, are taxed at a lower rate than short-term gains. In the United States, long-term capital gains tax rates are typically 0%, 15%, or 20%, depending on the investor's income level, whereas short-term gains are taxed at ordinary income tax rates, which can be as high as 37%. By holding investments for longer periods, wealthy individuals can take advantage of these lower tax rates, significantly reducing their tax burden on investment gains. Wealthy individuals also utilize municipal bonds as part of their tax-efficient investing strategy. Interest income from municipal bonds is generally exempt from federal income tax and, in some cases, state and local taxes as well. This tax-exempt status makes municipal bonds particularly attractive to high-net-worth investors in higher tax brackets, as they can generate tax-free income while supporting public projects like schools, highways, and hospitals. Another tax-efficient investment vehicle is the Health Savings Account, HSA. HSAs offer a triple tax advantage. Contributions are tax-deductible, the account grows tax-free, and withdrawals for qualified medical expenses are tax-free. For the wealthy, HSAs can serve as both a way to save for healthcare costs and an additional tax-advantaged investment account, especially since unused funds can be carried over indefinitely and invested for long-term growth. Charitable giving is another strategy employed by the wealthy to manage taxes. Donations to qualified charitable organizations can be deducted from taxable income, reducing the overall tax liability. Wealthy individuals often establish donor-advised funds or private foundations, which allow them to make charitable contributions, receive an immediate tax deduction, and distribute funds to charities over time. This approach not only provides tax benefits but also supports philanthropic goals. The use of trusts is a sophisticated tax planning tool. Trusts can be structured to manage and distribute assets in a tax-efficient manner. For example, irrevocable trusts can remove assets from an individual's taxable estate, reducing estate taxes. Grantor-retained annuity trusts, GRAs, and charitable remainder trusts, CRTs, are other examples that can provide significant tax advantages while allowing the grantor to retain income or make charitable contributions. Finally, wealthy individuals often work with tax advisors and financial planners to develop personalized tax strategies. These professionals help identify opportunities for tax savings, ensure compliance with tax laws, and optimize the timing of income and deductions. By staying informed about the latest tax regulations and leveraging their expertise, the rich can effectively minimize their tax liabilities and maximize their after-tax returns. 6. Dividend-paying stocks. Investing in dividend-paying stocks provides a steady stream of income in addition to potential capital appreciation. These stocks are particularly attractive to wealthy investors because they offer regular income payouts, which can be reinvested to compound returns or used as a reliable income source. The wealthy often favor blue-chip companies with a history of stable and growing dividends, as these companies typically have strong financials, established market positions, and a track record of profitability. Dividend-paying stocks are shares of companies that distribute a portion of their earnings to shareholders in the form of dividends. This regular income can be especially appealing during periods of market volatility, as dividends can provide a cushion against stock price declines. For wealthy investors, this means having a more predictable and less volatile income stream, which can be particularly useful in planning and managing their financial affairs. Blue-chip companies are large, well-established, and financially sound corporations with a history of reliable performance. These companies often dominate their industries and have a proven ability to generate steady profits. Examples include giants like Johnson & Johnson, Procter & Gamble, and Coca-Cola. By investing in blue-chip dividend-paying stocks, wealthy individuals can benefit from both capital appreciation and a consistent income stream. These companies tend to increase their dividends over time, which can help investors keep pace with inflation and grow their income. Dividend growth investing is a strategy that focuses on buying stocks of companies that have a history of increasing their dividends. Wealthy investors often seek out companies that consistently raise their dividends, as this can lead to substantial income growth over the long term. Dividend growth stocks not only provide regular income, but also signal financial health and management's confidence in the company's future earnings. This strategy aligns well with the goal of wealth preservation and growth. In addition to providing a steady income stream, dividend-paying stocks offer tax advantages. Qualified dividends in the United States are taxed at lower rates than ordinary income, which can result in significant tax savings for wealthy investors. For those in higher tax brackets, the difference between the tax rates on qualified dividends and ordinary income can be substantial, making dividend-paying stocks an efficient way to generate income. Reinvesting dividends is another powerful strategy that wealthy investors use to enhance their returns. By automatically reinvesting dividends to purchase additional shares, investors can take advantage of compounding, leading to exponential growth in their investment over time. Many brokerage firms and investment platforms offer dividend reinvestment plans, DRIPs, allowing investors to reinvest their dividends without incurring additional transaction fees. Diversification within the realm of dividend-paying stocks is also essential. Wealthy investors often spread their investments across various sectors, such as technology, healthcare, consumer goods, and utilities. This diversification reduces the risk associated with any single industry and ensures a more stable and reliable income stream. For example, while technology companies may offer high growth potential, consumer goods and utility companies often provide more consistent dividends. International dividend-paying stocks are another avenue for diversification and income generation. By investing in companies outside their home country, wealthy investors can tap into different economic cycles and growth opportunities. International dividends may also come with tax treaties that reduce withholding taxes, enhancing the overall return. Moreover, investing globally allows for exposure to emerging markets, which may offer higher dividend yields and growth potential. Dividend-focused exchange-traded funds, ETFs, and mutual funds provide an easy way for investors to gain exposure to a diversified portfolio of dividend-paying stocks. These funds invest in a broad range of companies that pay dividends, spreading risk and ensuring a steady income stream. Wealthy investors often use these funds to complement their individual stock holdings, achieving broader diversification and simplifying portfolio management. Lastly, the defensive nature of many dividend-paying stocks makes them particularly appealing in uncertain economic times. Companies that pay regular dividends often have stable earnings and strong cash flows, making their stocks less volatile during market downturns. This defensive characteristic provides an additional layer of security for wealthy investors, who prioritize capital preservation alongside income generation. 7. Municipal bonds. Municipal bonds offer tax-free interest income at the federal level and often at the state level as well, making them an attractive investment for wealthy individuals. These bonds are issued by state and local governments to finance public projects such as schools, highways, hospitals, and other infrastructure developments. The rich invest in municipal bonds to generate tax-efficient income while supporting local governments and community development. Tax-free interest income is one of the primary advantages of municipal bonds. The interest earned on these bonds is exempt from federal income taxes, and in many cases it is also exempt from state and local taxes if the investor resides in the issuing state. This tax-exempt status makes municipal bonds particularly appealing to high-net-worth individuals in higher tax brackets. For example, a wealthy investor in a high-tax bracket can benefit significantly more from tax-free municipal bond interest than from taxable bond interest. Investing in municipal bonds also provides a stable and predictable income stream. Municipal bonds typically pay interest semi-annually, offering regular income to investors. This reliability is especially valuable for wealthy individuals seeking consistent cash flow without the volatility associated with stocks. Additionally, municipal bonds are generally considered low-risk investments because they are backed by the taxing power of the issuing government entity. This perceived safety and stability make them a core component of many affluent investors' portfolios. Supporting local governments and infrastructure projects is another reason the rich favor municipal bonds. When wealthy individuals invest in these bonds, they are directly contributing to the funding of public projects that benefit their communities. This can include building new schools, repairing roads, or expanding public transportation systems. This dual benefit of earning tax-free income while contributing to community development aligns well with the philanthropic goals of many high-net-worth investors. Types of municipal bonds include general obligation bonds and revenue bonds. General obligation bonds are backed by the full faith and credit of the issuing government entity, meaning they are supported by the issuer's taxing power. Revenue bonds, on the other hand, are repaid from the revenues generated by specific projects, such as toll roads, airports, or water treatment plants. Both types offer tax-free income, but general obligation bonds are typically considered safer due to their broad tax-based backing. Diversification is another benefit of investing in municipal bonds. These bonds often have low correlation with other asset classes, such as stocks and corporate bonds. By including municipal bonds in their investment portfolios, wealthy individuals can reduce overall portfolio risk and achieve greater stability. This diversification is particularly important in times of economic uncertainty or stock market volatility, as municipal bonds can provide a hedge against market fluctuations. Credit quality is a crucial consideration when investing in municipal bonds. Wealthy investors often seek bonds with high credit ratings, which indicate a lower risk of default. Municipal bonds are rated by agencies such as Moody's, Standard & Poor's, and Fitch, with ratings ranging from AAA, highest quality, to C, lowest quality. Investing in higher-rated municipal bonds ensures greater safety and reliability, which is vital for preserving capital. Liquidity is an important factor for affluent investors when selecting municipal bonds. While municipal bonds are generally less liquid than stocks, many high-quality municipal bonds are actively traded in the secondary market, providing opportunities for investors to buy and sell as needed. Wealthy investors often work with financial advisors or brokers to access these markets and manage their bond portfolios effectively. Municipal bond funds and ETFs offer a convenient way for wealthy individuals to invest in a diversified portfolio of municipal bonds. These funds pool capital from multiple investors to purchase a wide range of municipal bonds, spreading risk and ensuring a more stable income stream. Municipal bond funds and ETFs also provide greater liquidity compared to individual bonds, as investors can buy and sell shares on the open market. 8. Alternative investments. Wealthy individuals allocate a portion of their portfolio to alternative investments, such as commodities, art, collectibles, and cryptocurrencies. These assets can provide diversification and hedge against inflation, offering opportunities to achieve returns that are uncorrelated with traditional investments like stocks and bonds. Alternative investments play a crucial role in a sophisticated investment strategy, helping to balance risk and return while enhancing overall portfolio performance. Commodities are tangible assets like gold, silver, oil, and agricultural products. Investing in commodities provides a hedge against inflation, as their prices often rise when the cost of living increases. For instance, gold has historically been viewed as a safe haven during periods of economic uncertainty and high inflation. Wealthy investors often include commodities in their portfolios to protect against the erosion of purchasing power and to benefit from price appreciation driven by supply and demand dynamics. Additionally, commodities can offer diversification benefits, as their performance is typically influenced by different factors than those affecting stocks and bonds. Art and collectibles represent another category of alternative investments favored by the rich. Fine art, rare coins, vintage cars, and other collectibles can appreciate significantly over time and offer both financial returns and personal enjoyment. The art market, for example, has seen substantial growth, with pieces by renowned artists fetching millions at auction. Wealthy individuals often work with art advisors and auction houses to identify valuable pieces and build collections that can serve as stores of value. Besides potential capital appreciation, investing in art and collectibles provides the added benefit of owning tangible, aesthetically pleasing assets that can be displayed and enjoyed. Cryptocurrencies have emerged as a popular alternative investment in recent years. Digital currencies like Bitcoin and Ethereum offer high potential returns, albeit with significant volatility. Wealthy investors allocate a portion of their portfolios to cryptocurrencies to capitalize on their growth potential and the technological innovation behind blockchain technology. Cryptocurrencies can also provide diversification benefits, as they often do not move in tandem with traditional financial markets. However, due to their speculative nature and regulatory uncertainties, investments in cryptocurrencies are typically limited to a small percentage of an overall portfolio. Private equity and venture capital also fall under the umbrella of alternative investments. While these were discussed previously, they are worth mentioning again, as they play a significant role in the portfolios of the wealthy. Private equity involves investing in established private companies, whereas venture capital focuses on early-stage startups with high growth potential. Both types of investments offer the opportunity for substantial returns and portfolio diversification. Real estate can also be considered an alternative investment, particularly when it involves unconventional properties such as farmland, timberland, or commercial real estate developments. These assets provide income through rents and leases and can appreciate significantly over time. Real estate investments offer diversification benefits and can act as a hedge against inflation, as property values and rental incomes typically increase with rising prices. Wealthy investors often include real estate in their alternative investment strategies to gain exposure to different economic sectors and asset types. Hedge funds are another popular alternative investment vehicle. As previously discussed, hedge funds employ various strategies to achieve high returns and manage risk. They can invest in a wide range of assets, including equities, bonds, derivatives, and commodities, providing diversification and potentially outsized gains. Wealthy individuals invest in hedge funds to access sophisticated investment techniques and benefit from the expertise of professional fund managers. Collective investment schemes such as infrastructure funds and natural resource funds offer additional opportunities for alternative investments. Infrastructure funds invest in projects like toll roads, airports, and utilities, providing steady cash flows and long-term growth potential. Natural resource funds focus on assets like oil, gas, and minerals, offering exposure to commodity price movements and the potential for significant returns. These funds enable wealthy investors to gain access to specialized markets and assets that may be difficult to invest in directly. 9. International investments. Investing in international markets helps the rich diversify their portfolios and tap into growth opportunities in emerging economies. This strategy includes foreign stocks, bonds, and real estate, allowing wealthy individuals to spread their investments across different geographic regions and benefit from global economic growth trends. Foreign stocks offer wealthy investors access to companies based outside their home country. Investing in international stocks provides diversification benefits, as the performance of foreign markets may not always correlate with domestic markets. For example, during periods of economic expansion in emerging markets, stocks in those regions may outperform stocks in developed markets. Wealthy individuals often work with financial advisors or invest in international mutual funds and ETFs to gain exposure to a broad range of foreign stocks while managing currency risk and geopolitical factors. International bonds are another component of international investments. These bonds are issued by foreign governments and corporations, offering wealthy investors exposure to different interest rate environments and credit markets. International bonds can provide diversification benefits, as they are influenced by factors such as global economic conditions and geopolitical events. Some wealthy investors allocate a portion of their fixed income portfolios to international bonds to enhance yield potential and manage interest rate risk. Real estate investments in international markets allow wealthy individuals to diversify their property holdings geographically. International real estate can include residential, commercial, and hospitality properties in foreign countries. Investing in international real estate provides opportunities for capital appreciation and rental income, as well as exposure to different real estate cycles and economic conditions. Wealthy investors often partner with local real estate developers or invest in real estate investment trusts, REITs, focused on international markets to gain access to property investments abroad. Emerging markets are a specific focus within international investments. These markets encompass economies that are experiencing rapid industrialization and growth, such as Brazil, China, India, and many countries in Southeast Asia and Africa. Wealthy investors allocate capital to emerging markets to capitalize on their potential for higher economic growth rates and investment returns compared to developed markets. Emerging markets offer opportunities across various sectors, including technology, consumer goods, financial services, and infrastructure development. Currency diversification is an important consideration in international investing. Wealthy individuals may hold foreign currencies as part of their investment strategy to hedge against currency fluctuations or take advantage of potential appreciation. Currency markets can be volatile, influenced by factors such as interest rate differentials, geopolitical events, and economic policies. Some investors use currency hedging strategies or invest in currency ETFs to manage currency risk while maintaining exposure to international markets. Political and regulatory considerations are also crucial when investing internationally. Wealthy investors assess the stability of foreign governments, legal systems, and regulatory environments before allocating capital to international markets. Political stability and transparency can impact investment returns and the safety of assets held abroad. Some investors work with international legal advisors and consultants to navigate regulatory complexities and ensure compliance with local laws. Global diversification enhances the resilience of wealthy investors' portfolios against market volatility and economic downturns. By spreading their investments across different regions and asset classes, including international stocks, bonds, and real estate, they can reduce concentration risk and potentially enhance long-term returns. International investments offer opportunities for growth and income generation in diverse economic environments, aligning with the goals of preserving and growing wealth over time. In conclusion, international investments are integral to the investment strategies of wealthy individuals seeking diversification, growth opportunities, and risk management. By investing in foreign stocks, bonds, and real estate, as well as focusing on emerging markets and currency diversification, the rich can build resilient portfolios that capture global economic trends and mitigate local market risks. International investing requires careful research, strategic planning, and ongoing monitoring to capitalize on opportunities and navigate challenges in global financial markets. 10. Annuities. Annuities are insurance products that provide a guaranteed income stream, typically for retirement. Wealthy individuals use annuities to ensure a stable cash flow and reduce longevity risk, making them a valuable component of retirement planning and wealth management strategies. Types of annuities include immediate annuities and deferred annuities. Immediate annuities are purchased with a lump sum and begin paying out income immediately or shortly after purchase, providing an instant stream of income for retirees. Deferred annuities, on the other hand, are funded over time and start paying out at a future date, allowing investors to accumulate savings and benefit from tax-deferred growth before converting to an income stream. Wealthy individuals may choose between these types based on their retirement timeline and financial goals. Guaranteed income is a primary attraction of annuities for wealthy investors. Annuities offer predictability and security by guaranteeing regular payments for a specified period or for life, regardless of market conditions or fluctuations. This feature is particularly appealing for retirees seeking to cover essential living expenses and maintain their standard of living throughout retirement. By converting a portion of their assets into an annuity, wealthy individuals can create a reliable source of income that complements other retirement income streams, such as Social Security and pensions. Longevity risk refers to the risk of outliving one's savings. Annuities help mitigate longevity risk by providing income for as long as the annuitant lives, ensuring financial security throughout retirement. Wealthy individuals often use annuities as a longevity hedge, knowing that even if they live longer than expected, they will continue to receive regular payments. This peace of mind allows retirees to focus on enjoying their retirement years without the stress of financial uncertainty. Tax advantages are another benefit of annuities. While contributions to annuities are made with after-tax dollars, earnings within the annuity grow tax-deferred until withdrawals are made. This tax deferral can enhance the growth of invested funds over time, as earnings compound without being reduced by annual taxes. Wealthy investors in higher tax brackets may find annuities particularly advantageous for retirement planning, as they can defer taxes on investment gains during their peak earning years and potentially withdraw funds in retirement when they may be in a lower tax bracket. Flexibility in annuity products allows wealthy investors to customize their retirement income strategy. Some annuities offer options to adjust payment schedules, choose between fixed or variable income payments, or add riders for additional benefits, such as inflation protection or long-term care coverage. Wealthy individuals often work with financial advisors to select annuities that align with their specific financial goals and retirement needs, ensuring a personalized approach to income planning. Considerations when investing in annuities include fees, surrender charges, and liquidity constraints. Annuities may have upfront costs and ongoing expenses, such as administrative fees and mortality and expense charges. Surrender charges may apply if the annuitant withdraws funds early or makes changes to the contract before a specified period. Additionally, annuities are generally illiquid investments, as they are designed to provide long-term income rather than immediate access to cash. Wealthy investors evaluate these factors carefully to determine the suitability of annuities within their overall investment portfolio and retirement income strategy. In conclusion, annuities play a vital role in the retirement planning of wealthy individuals, offering guaranteed income, mitigating longevity risk, providing tax advantages, and enhancing financial security. By incorporating annuities into their portfolios, the rich can create a stable cash flow that complements other retirement income sources and supports their lifestyle throughout retirement. With careful consideration of product features, costs, and long-term objectives, annuities can be an effective tool for preserving and growing wealth while ensuring a comfortable and worry-free retirement. 11. Trusts and estate planning. Creating trusts and engaging in estate planning allows the wealthy to manage and protect their assets, ensure a smooth transfer of wealth to heirs, and minimize estate taxes. These strategies are essential components of wealth management, enabling affluent individuals to preserve their legacy and provide for future generations. Trusts are legal entities that hold assets on behalf of beneficiaries according to specific terms set out by the grantor or trust creator. Wealthy individuals establish trusts to achieve various objectives, such as asset protection, charitable giving, and estate tax reduction. By transferring assets into a trust, the grantor can designate how and when beneficiaries receive distributions, ensuring responsible management and protection against mismanagement or squandering of assets. Trusts can also shield assets from creditors and legal claims, providing additional security and peace of mind for the wealthy. Types of trusts include revocable trusts and irrevocable trusts. Revocable trusts allow the grantor to retain control over trust assets during their lifetime and make changes or revoke the trust if desired. These trusts are often used for probate avoidance and privacy, as assets transferred to a revocable trust generally bypass the lengthy and public probate process. Irrevocable trusts, on the other hand, cannot be modified or revoked once established, providing greater asset protection and estate tax benefits. Irrevocable trusts are commonly used for estate tax planning, charitable giving, and protecting assets from estate taxes and creditors. Estate planning encompasses a broader set of strategies and legal documents designed to manage an individual's assets during their lifetime and ensure their wishes are carried out after death. Wealthy individuals engage in comprehensive estate planning to minimize taxes, designate beneficiaries, and provide clear instructions for the distribution of their wealth. Estate planning documents may include wills, trusts, powers of attorney, and healthcare directives, each serving a specific role in managing financial affairs and healthcare decisions. Tax efficiency is a key consideration in trust and estate planning for wealthy individuals. By strategically structuring trusts and estate plans, affluent individuals can minimize estate taxes and maximize the value of assets passed on to heirs. Trusts such as irrevocable life insurance trusts, ILITs, and qualified personal residence trusts, QPRTs, offer opportunities to leverage tax exemptions, deductions, and credits to reduce the overall tax burden on estates. Wealthy individuals often work closely with estate planning attorneys and financial advisors to develop personalized strategies that align with their financial goals and family circumstances. Asset protection is another significant benefit of trusts and estate planning for the wealthy. By placing assets into trusts or structuring them within a comprehensive estate plan, individuals can shield their wealth from potential legal claims, creditors, and other liabilities. Trusts, particularly irrevocable trusts, provide a legal barrier between assets and external threats, safeguarding wealth for future generations and charitable endeavors. Asset protection strategies also involve considerations of jurisdiction, legal structures, and ongoing management to ensure compliance with laws and regulations. Family governance is increasingly emphasized in trust and estate planning for wealthy families. Establishing family constitutions, advisory boards, and governance structures helps to clarify roles and responsibilities, promote communication, and preserve family values and legacies across generations. These governance mechanisms ensure continuity in managing family wealth, charitable foundations, and business interests, fostering unity and alignment among family members. Philanthropy plays a significant role in trust and estate planning for the wealthy. Many affluent individuals incorporate charitable trusts, foundations, and donor-advised funds into their estate plans to support causes they are passionate about while achieving tax advantages. Charitable giving not only benefits society, but also allows donors to leave a lasting legacy and involve family members in philanthropic activities. Wealthy individuals often use estate planning strategies to maximize the impact of their charitable contributions while minimizing tax implications for their estates. 12. Stock options and derivatives. Stock options and derivatives are financial instruments used by wealthy individuals to hedge against market volatility, generate income, or speculate on price movements. These tools are integral to sophisticated investment strategies and risk management techniques employed by affluent investors. Stock options provide the right, but not the obligation, to buy or sell a specific amount of stock at a predetermined price, strike price, within a specified period, expiration date. Wealthy individuals use stock options for various purposes, including hedging existing positions, enhancing portfolio returns, and managing risk exposure. For example, a wealthy investor holding a large position in a particular stock may purchase put options to protect against a potential decline in the stock's price, thus hedging against downside risk. Alternatively, investors may sell covered call options on stocks they already own to generate additional income through premiums while potentially earning capital gains if the stock price remains stable or rises. Derivatives encompass a broader category of financial contracts whose value is derived from an underlying asset, index, or interest rate. Common types of derivatives include futures, forwards, swaps, and options. Wealthy individuals utilize derivatives to hedge against price fluctuations, speculate on market trends, and manage portfolio risk. For instance, a wealthy investor concerned about rising interest rates may enter into an interest rate swap to exchange a variable interest rate payment for a fixed one, thereby mitigating interest rate risk on their investments. Risk management is a primary motivation for the use of stock options and derivatives by the rich. These financial instruments enable investors to protect their portfolios against adverse market movements and unforeseen events. By strategically incorporating options and derivatives into their investment strategies, affluent individuals can tailor risk exposure, enhance returns, and preserve capital during volatile market conditions. This proactive approach to risk management is critical for maintaining wealth and achieving long-term financial goals. Income generation is another significant benefit of stock options and derivatives for wealthy investors. Option strategies such as selling covered calls or cash-secured puts can generate premiums, which provide immediate income while potentially acquiring or selling stocks at favorable prices. Derivatives like dividend swaps allow investors to capitalize on expected dividend payments without owning the underlying stocks, providing additional sources of income and enhancing overall portfolio yield. Leverage is a characteristic feature of derivatives that allows investors to control a larger position with a smaller initial investment. While leverage can amplify returns, it also magnifies risks, making risk management crucial when using derivatives. Wealthy investors often employ sophisticated hedging strategies and closely monitor market conditions to mitigate potential losses associated with leveraged positions. By balancing leverage with risk tolerance and investment objectives, affluent individuals can capitalize on market opportunities while protecting their wealth. Strategic allocation of stock options and derivatives within a diversified portfolio is essential for wealthy investors. These financial instruments complement traditional investments such as stocks, bonds, and real estate by offering alternative ways to achieve specific financial objectives. For example, option strategies can be tailored to enhance income in a low-yield environment or protect against downside risk during market downturns. Derivatives provide flexibility and liquidity, allowing investors to adjust their positions quickly in response to changing market conditions and investment goals. Regulatory compliance and market liquidity are critical considerations when trading stock options and derivatives. Wealthy investors must adhere to regulatory requirements and understand the complexities of derivative contracts, including margin requirements, settlement procedures, and counterparty risk. Market liquidity ensures that derivatives can be bought or sold efficiently without significantly impacting market prices, enabling investors to enter and exit positions seamlessly. In conclusion, stock options and derivatives are powerful tools used by wealthy individuals to manage risk, generate income, and capitalize on market opportunities. By incorporating these financial instruments into their investment portfolios, affluent investors can enhance returns, protect capital, and achieve their financial goals in a dynamic and evolving market environment. Strategic use of stock options and derivatives requires expertise, careful planning, and ongoing monitoring to effectively navigate risks and optimize performance over time. 13. Impact investing. Impact investing involves wealthy individuals investing in companies and projects that generate social or environmental benefits alongside financial returns. This strategy allows affluent investors to align their investment portfolios with their values and contribute to positive social change while seeking profitable opportunities. Objectives of impact investing extend beyond financial gains to include measurable social or environmental outcomes. Wealthy individuals prioritize investments that address pressing global challenges such as climate change, poverty alleviation, healthcare access, education, and sustainable development. By deploying capital into impactful ventures, investors aim to catalyze positive change and create lasting benefits for communities and the planet. Types of impact investments encompass a wide range of asset classes and sectors. Examples include renewable energy projects, affordable housing developments, microfinance initiatives, sustainable agriculture ventures, and technology innovations aimed at improving healthcare and education access. Wealthy individuals often collaborate with impact investment funds, venture capital firms, and philanthropic organizations to identify and support high-impact opportunities aligned with their values and financial objectives. Measuring impact is a fundamental aspect of impact investing for wealthy individuals. Investors employ metrics such as environmental, social, and governance (ESG) criteria, social return on investment (SROI), and impact reporting and investment standards (IRS) to assess the social and environmental performance of their investments. These frameworks enable investors to evaluate the effectiveness of their capital deployment and track progress towards achieving positive outcomes and sustainable development goals. Integration of impact investing into wealth management strategies reflects a growing recognition of the interconnectedness between financial success and social responsibility. Wealthy individuals seek to leverage their financial resources and influence to drive positive change and address societal challenges through strategic investments. Impact investing allows investors to play an active role in shaping a more equitable and sustainable future while diversifying their investment portfolios and managing risk. Challenges associated with impact investing include balancing financial returns with social impact objectives and navigating the complexities of measuring and reporting impact. Wealthy investors must conduct thorough due diligence, assess risk factors, and align investment opportunities with their personal values and philanthropic goals. Additionally, impact investments may require longer time horizons for achieving both financial and social returns, necessitating patience and commitment from investors. Industry growth and impact investment opportunities continue to expand as awareness and demand for sustainable and socially responsible investing practices grow globally. Wealthy individuals play a pivotal role in driving innovation and scaling impact initiatives that address systemic challenges and contribute to inclusive economic growth. By allocating capital towards impactful investments, affluent investors can create meaningful change while achieving competitive financial returns and building a legacy of responsible stewardship. In conclusion, impact investing represents a powerful avenue for wealthy individuals to deploy capital strategically, align investment decisions with their values, and drive positive social and environmental change. By integrating impact investments into their wealth management strategies, affluent investors can generate measurable impact alongside financial returns, contributing to a more sustainable and equitable global economy. Impact investing reflects a commitment to leveraging private wealth for the greater good and shaping a future where prosperity and social well-being are mutually reinforcing priorities. 14. Leveraging debt. Using debt strategically can amplify investment returns, a tactic frequently employed by wealthy individuals to invest in income-generating assets like real estate or to expand their business operations. Leveraging debt allows affluent investors to access capital beyond their immediate financial resources, leveraging their existing wealth to maximize investment opportunities and enhance overall portfolio performance. Real estate investments are a prime example of how wealthy individuals leverage debt to amplify returns. By obtaining mortgage financing or using other forms of debt, investors can acquire properties with a fraction of the total purchase price as a down payment. This leverage magnifies the potential return on investment, ROI, by allowing investors to control a larger asset base and benefit from property appreciation and rental income. Wealthy investors often use debt financing to build diversified real estate portfolios across residential, commercial, and industrial properties, capitalizing on market cycles and rental demand to generate passive income and long-term wealth accumulation. Business expansion is another strategic use of debt by wealthy individuals. Entrepreneurs and business owners leverage debt to fund growth initiatives, such as expanding production facilities, launching new product lines, or acquiring competitors. Debt financing provides immediate access to capital while preserving liquidity for other operational needs and investment opportunities. By leveraging debt for business expansion, affluent individuals can accelerate revenue growth, gain market share, and enhance profitability, thereby maximizing shareholder value and positioning their enterprises for long-term success. Risk management plays a crucial role in leveraging debt for wealthy investors. While debt can amplify returns, it also increases financial risk and exposure to interest rate fluctuations, market downturns, and economic uncertainties. Wealthy individuals mitigate these risks by carefully evaluating debt-to-equity ratios, securing favorable loan terms, and maintaining sufficient cash reserves to cover debt service obligations. Effective risk management strategies ensure that leveraging debt enhances portfolio diversification and resilience rather than exposing investors to undue financial strain or volatility. Tax advantages are another consideration when leveraging debt for investment purposes. Interest payments on debt used for income-generating investments, such as real estate or business operations, are often tax-deductible, reducing taxable income and enhancing after-tax returns. Wealthy investors strategically structure debt financing to optimize tax efficiency while leveraging their investment portfolios to achieve long-term financial objectives. By aligning debt financing with tax planning strategies, affluent individuals can maximize cash flow, preserve capital, and capitalize on growth opportunities in a cost-effective manner. Long-term perspective is essential when leveraging debt as part of an investment strategy. Wealthy individuals assess the potential return on investment, repayment terms, and market conditions to ensure that debt financing aligns with their financial goals and risk tolerance. By maintaining a disciplined approach to debt management and investment decision-making, affluent investors can leverage debt to capitalize on opportunities for wealth creation, diversification, and portfolio expansion while safeguarding their financial well-being and legacy. Wealth preservation is a core objective of leveraging debt for affluent individuals. By strategically deploying debt to acquire income-generating assets and expand business operations, wealthy investors enhance cash flow, asset liquidity, and overall portfolio value. Effective debt management practices, including regular monitoring of debt levels and interest rates, enable affluent individuals to optimize investment returns, mitigate financial risks, and sustain long-term wealth accumulation across economic cycles. In conclusion, leveraging debt strategically allows wealthy individuals to amplify investment returns, access capital for real estate investments and business expansion, manage financial risks, and optimize tax efficiency. By integrating debt financing into their investment strategies with a focus on long-term growth and wealth preservation, affluent investors can capitalize on market opportunities, enhance portfolio diversification, and achieve their financial objectives while maintaining financial flexibility and resilience. Strategic debt management and prudent risk assessment are essential for maximizing the benefits of leveraging debt and ensuring sustainable wealth accumulation and legacy preservation over time. 15. Family offices. Many wealthy families establish family offices to manage their investments, financial planning, and administrative needs effectively. These specialized entities provide comprehensive and personalized services tailored to the unique requirements of affluent individuals and their families, offering centralized control and coordination of wealth management activities. Purpose and scope. Family offices serve as dedicated entities designed to oversee and optimize the financial affairs of wealthy families. They typically manage a wide range of responsibilities, including investment management, asset allocation, tax planning, estate planning, philanthropic initiatives, and intergenerational wealth transfer strategies. By consolidating these functions under one roof, family offices streamline decision-making processes, enhance efficiency, and ensure alignment with the family's long-term financial goals and values. Services offered. Family offices offer a suite of specialized services to meet the diverse needs of affluent families. These services may include portfolio management, where skilled investment professionals develop and execute customized investment strategies aligned with the family's risk tolerance and return objectives. Financial planning services address complex wealth management issues such as retirement planning, education funding, insurance coverage, and charitable giving, tailored to individual family members' needs. Governance and control. Establishing a family office enables wealthy families to maintain greater control and oversight over their financial affairs. Family members often play active roles in decision-making processes, collaborating closely with dedicated professionals and advisors hired by the family office. This governance structure promotes transparency, accountability, and alignment of interests among family members, ensuring that financial decisions are made in accordance with the family's values, objectives, and long-term vision. Investment strategy. Family offices develop sophisticated investment strategies designed to preserve and grow wealth over generations. These strategies may encompass diversified portfolios across asset classes, including equities, fixed income, real estate, private equity, and alternative investments. Family offices leverage their expertise and access to exclusive investment opportunities to pursue favorable risk-adjusted returns while managing volatility and liquidity considerations. Customization and flexibility. One of the primary advantages of family offices is their ability to provide personalized and flexible solutions tailored to the unique circumstances and preferences of each family member. Whether addressing complex tax implications, overseeing philanthropic initiatives, or planning for generational wealth transfer, family offices adapt their services to accommodate evolving needs and changing market conditions, ensuring continuity and sustainability of wealth management practices. Confidentiality and privacy. Family offices prioritize confidentiality and privacy, safeguarding sensitive financial information and personal details of family members. They operate discreetly and uphold strict confidentiality agreements to protect the privacy and security of the family's assets and affairs. This commitment to confidentiality fosters trust and enables family members to discuss sensitive matters openly within the trusted environment of the family office. Multi-generational legacy. Family offices play a crucial role in preserving and perpetuating multi-generational wealth and legacy. By implementing robust governance structures, succession planning strategies, and educational programs, family offices empower future generations to steward wealth responsibly, uphold family values, and pursue philanthropic endeavors aligned with the family's collective vision and aspirations. Global reach and expertise. Many family offices operate on a global scale, leveraging international investment opportunities, strategic partnerships, and cross-border wealth management solutions. They navigate regulatory complexities, currency fluctuations, and geopolitical risks to optimize investment outcomes and capitalize on emerging market trends. Family offices harness their global reach and specialized expertise to deliver comprehensive wealth management services that meet the evolving needs of globally diversified families. Community and impact. Beyond financial management, Family offices often engage in philanthropy and community impact initiatives to create positive social change and contribute to sustainable development goals. They support charitable causes, establish foundations, and promote environmental stewardship, reflecting the family's commitment to corporate social responsibility and making a meaningful impact on society.